it going? Just really wanted to touch base. I know that there's so much craziness going on right now. I wanted to just take a second, talk about everything that's going on, put some headlines into perspective, talk about what we're doing with our models, and just kind of ease some worry that investors may be having right now. So I really do not think that I'm surprising anybody by letting you know that the market has been going pretty bonkers lately. It's been all over the place, not looking great as of the beginning of 2022 here. Kind of feels like we're on the Tower of Terror, quite honestly. If you've never ridden the ride, one of my least favorite rides of all time, along with about any other ride that I've ever been on. But you get on the Tower of Terror, right? You sit down, you're in this comfy-ish chair, and you ride the elevator deal all the way up to the top. And when it gets to the top, the doors open and you look out over all of Disneyland, and it's just really pretty, honestly. Like, you're sitting up there and just checking out all the stuff that's going on. You can see all the pretty buildings. I mean, it's just a cool view. And right as you turn to your neighbor, whoever you're sitting next to, and say, hey, can you see that? Boom, it falls, and your stomach's in your throat. Feels like it's gonna just fall forever. It's never gonna end. You have no idea when it's gonna stop. At least I'm grasping onto the handlebars really tight, and just feels absolutely crazy. So that's maybe the feeling that you're feeling currently. And I really, again, I want to talk about what's actually going on to relieve some of that tension for you. So 3 months ago, we were at the top of the Tower of Terror. We hit all-time highs on November 22nd. And since then, it's, again, like we've been on that Tower of Terror ride. So I want to help manage some emotions, again, give some historical context, talk about what actually is going on so you're not just reading headlines and, feeling very, very anxious about this stuff. First headline that I want to address is Russia invading Ukraine. Again, probably not new news to anybody, but Russia did launch their invasion today. Pretty brutal pictures. Obviously, hearts and prayers go out for all the people involved in that, and it's a horrible, horrible deal. But from an investment standpoint, war brings a lot of uncertainty with investments. It brings a lot of people wanting to get risk off the table, become very, very defensive. And that's why we're seeing some of these major pullbacks. And as more news develops, I don't see any reason why that volatility is going to go away in the short term. It's going to continue for a little bit here. We're going to get more news. I'm sure that there's going to be some more chaos over in Ukraine, and it's going to drive the market a little bit further down. So I'm still expecting to see some short-term volatility and some short-term pullbacks going forward here, which really we have not seen this high of levels of uncertainty and fear since 2016, which was right before Brexit. And contrary to popular belief, when levels of fear and uncertainty are very high, actually the market tends to perform well following that. Since 1990, when levels of fear and uncertainty was the last time that those levels were this high, the market has on average returned 18% during the next 12 months. And just so you know, when I'm talking about levels of uncertainty, right, they send out all these surveys that basically portray to investors whether they're bullish, bearish, or neutral. So being bearish and neutral determines that there's lots of fear and uncertainty within the marketplace. So from this war, again, obviously not something that we want to happen and not a great deal. But again, from an investment standpoint, these pullbacks and everything that's going on, I believe is going to present some new buying opportunities within the short run here. Okay, next major headline is we are in a correction. And that's such a scary word. I mean, what the heck, a correction? What does that even mean? So a correction is if the market falls more than 10%, but less than 20. That's what actually signifies a correction. A decline of more than 20%, that's actually falling into bear market territory. So on Tuesday, actually, the S&P hit a correctional territory for the first time since 2020. And that happened, after the NASDAQ, which is a tech-heavy index, already hit correction territory prior to that. Again, short term, this kind of scary jargon, it gets that feeling in your stomach again of the Tower of Terror ride. And I wish I could tell you that this was going to be a linear process. It only goes up, that the market is just constantly a good thing and never falls in value. Well, that's obviously not the case. This is part of the journey, and I cannot stress to you enough that the only people that get hurt on the ride or on the roller coaster ride, whatever it is, are the ones that jump off at the top and don't ride it all the way out. We have to keep in mind that in order to win with investing, it's about time in the market and not timing the market. And if you were a client of mine back in 2020 when all the COVID craziness was beginning and the market was going in a panic, then you've been hearing me say this for a while, but I just cannot reiterate this enough when we have such craziness going on. So, okay, back to the market correction. What does this historically mean? What normally happens when we hit correction territory? Well, first off, there have been over 30 market corrections. Well, actually, almost, sorry. There's been a little bit less than 30, almost 30 market corrections since World War II. And those corrections have, on average, led to a 13.7% decline in the overall market. Now, the good news is those, on average, have rebounded within the next 4 months after that. So, again, I'm not saying no crystal ball here that we're going to be just fully recovered and back in full force by July, but I think looking at a historical perspective like that can help to ease some of the tensions that you might be feeling. Also, looking at the historical performance of just the Dow Jones here, over the last 20 correctional periods, the Dow has been positive the next 12 months later, 15 out of the 20 times. So 75% of the time over the last 20 corrections, the Dow has been back in positive territory over the next year. And again, I'm telling you all this just to help lower the boldness of the headlines that are coming through, because they're going to keep rolling. All these crazy headlines, they're going to continue to come. And it's so easy to read those things and just think about short-term investments, where we really need to keep the long-term in perspective and think about your long-term goals. Okay, last major headline that I want to address is the Fed talking about inflation. And we've been talking about this for a while now, the Fed tapering. They've been coming in saying they're going to raise interest rates, basically pumping the brakes on what was the red hot economy, right? So at some point, the war is going to make this a little bit more complicated. So we don't know how much the Fed is actually going to increase interest rates. It's really just a guessing game. They could increase by 50 basis points or half a percentage in March. Maybe it's only 0.25%. Maybe they don't do anything at all, which I doubt it. But this is definitely a headwind. It really makes things a little bit more complicated. It does add a lot of complexity to the situation. And again, overall, I don't think that the war is going to stop the Fed from pumping the brakes on the economy. So that's something that we're going to have to pay close attention to and keep an eye on going forward, because it is definitely going to slow things down a little bit. Okay, so that's a lot of news. That's a lot of what the headlines are saying right now. Then what the heck does that mean for what's going on with our portfolios and what do we plan to do going forward? Well, our investment committee has decided to raise cash. So normally we sit in about 3% cash across all the portfolios just to take advantage of short-term buying opportunities, shorter-term plays, opportunistic stuff that we see. We have been raising cash for over the last month, and we're getting up to about the 12 to 15% cash range, which is really abnormally high for us. I never ever believe in sitting in 100% cash. You guys all know that, and I'll tell you here in a second why. But I do think it is a really good time to have a little bit more cash on the sidelines, be more defensive, and then over the next few months, not starting right away, take our time and buy back in slowly as better and better buying opportunities continue to present themselves, like I think that they will. Okay, so why not just go into 100% cash and wait to buy back in when we actually hit the bottom? Well, first off, I wish that there was a green light that would turn on when it told us that we're at the bottom of the market. That never happens. It's an impossible game to play. And I like to give this number because it's absolutely crazy. Looking at the market going back since 1930, that's 92 years of market time. I mean, that's just a huge, huge amount. The return of the overall market, if you were just invested and you did not get out, you just stayed invested for those 92 years, is over 17,000%. It's like 17,712%, I believe. If you missed the best 10 trading days of 92 years, just 10 days out of 92 years that you might not have been in the market, you went from a 17,000% return to a 28% return. It's absolutely mind-boggling. So that is why we cannot time these things. We never know when a major pullback is going to happen, when we have a major spring forward. I mean, we saw it during the coronavirus. For everybody that held tight, stuck with the game plan, and was patient, we saw a major quick recovery. Again, I'm not saying that that's going to happen in this case, but it will come back. There's never been anything that we have not recovered from. Wars, viruses, recessions, whatever, you name it, we've always recovered, at least the broader market. Now, if we're talking about very, very risky assets, single stocks, cryptocurrencies, those sorts of things without the long track record, who knows what could happen. But by being long-term diversified and investing in long-term United States capitalism, you're always going to do well. All right, guys, so I just wanted to get this out to you. Make sure that you're okay with everything that's going on. Make sure that you have a little bit of an understanding of what we're planning for, why the market's behaving so crazily, and most importantly, if you do have any questions, if you have any concerns, you want to talk about your personal portfolio or talk about your personal game plan that we've built, please don't hesitate to reach out. More than happy to chat and just talk about anything with you. So I'll leave you guys with that. Sure appreciate it. Hope that everything's going well besides all the craziness here, and we'll keep in touch.